want to talk about today is how to minimize your losses by up to 62%. And I'm going to show you 3 methods that you can do this with. And I'm just going to write these on the screen, and then I'm going to discuss each one. And the first method is a retracement to the trend line. That's method number 1. Method number 2 is a retracement to a Fibonacci level. And method number 3 is a retracement to a candle body. And what we're going to do is use all 3 of these methods upon entry to the trade to try and minimize the risk that is involved in the trade. In other words, when we enter the trade, we want to reduce the stop loss required as much as possible by waiting for a retracement. And of course, I'm referring to all of this using the E75 system. So I've got the first example here, which is the retracement to the trend line. So this is what we're going to have a look at now. This is the retracement to the trend line. Now you can see right here that we have a trade entry. There's our trend line. We've gone from the bottom Bollinger Band to the top Bollinger Band, and we've got an overbought stochastic. The next thing we need to check is to see whether this trend line, starting here and ending here, so in other words the period from there to there, is 3 hours long or longer, and that one is all in order. So we've got all the conditions for a trade here right this moment, and this is the dollar yen. You can see I'm talking about the dollar yen, and this is on a 5-minute chart. And what we want to do right now is to estimate the stop loss involved in the trade. So the first thing I can do is put the cursor on here and have a look at the entry price, which was actually right here, and the entry price on this trade was 97.62. The high of this area here, where the stop loss needs to be above, is 97.84. So that gives us a 22 pip potential 22 pip stop loss, and that's not bad. In fact, that's an excellent stop loss for the trade that we want to get into. Remember, our stop loss needs to be less than 30 pips, ideally. And if we can get that down to, say, 20 pips or less, then we're doing really well. Because remember, we're aiming for 40 to 60 pips on each trade, and we also want a 2-to-1 risk-reward ratio. So if our stop loss is 20 pips, we should be aiming for somewhere around 40 on the trade. If our stop loss is 30 pips, we want to be aiming for somewhere around about 60 pips on the trade, and that gives us a 2-to-1 risk-reward ratio. So in this case, we've got a 22 pip stop loss, which is excellent, and that is, of course, if we enter the trade at that point there, at the initial indication or the initial signal. Now, what often happens is during trading, once we get a trade entry like we did there, what often happens is this trend line here, which was initially resistance, becomes support. So all along here, the other way around, all along here, the trend line has been support. Okay, so every time the price has touched the trend line, it's bounced back up again, and that line has acted as support all the way along here. And this is about, I suppose, 4 hours. I'm not sure because I can't see the bottom there, but it's at least a 4-hour trend line. So this line has been a support trend line. And remember, when you're drawing trend lines, when you're going up, as we are here, always draw the trend line underneath the trend. And when we're going down, for example, if we had a trend like this, you always draw the trend line on top of the price action. And often people get confused with this concept, and they would draw the trend line on top of an upward trend instead of underneath the upward trend. And in fact, if you draw the trend line on top of the upward trend, that becomes a channel line and not a trend line. Okay, but I digress. Now, what often happens during trading is that this line, which was support, then becomes inversed, and it then becomes resistance. And that's a general rule that you can apply to trend lines. You can apply that to horizontal lines of support and resistance. Forget the writing there, you know what I mean, and you can apply that to Fibonacci levels, whatever it might be. Any line that was support or resistance, once that's been broken, then inverts and becomes the opposite. So support becomes resistance, resistance becomes support. In this case right here, this support line then becomes resistance. So what often happens is that once the initial support has been broken, and that was that entry level there, that's where the support was broken clearly, that line then becomes a resistance line. And often the price will then retrace back to the resistance line, just as it has done here. So it's moved from there back up to here, and it's retraced back up to the underneath of the trend line. Now that underneath is the area where we would want the price to stop, where we would want the price to turn around, because that trend line, which was resistance, we want now to act as support to keep this price or trend reversal moving lower. And that's exactly what's happened in this case. And you can see right here that we've moved up, we've touched the trend line from underneath, and what we've now got, let me just put the cursor on here, is instead of an entry at 97.62, we're able to enter the trade at the high of this candle, and that's 97.71. So that's given us a 9 pip advantage, a 9 pip lower risk on the trade. So instead of 62, we can now get in at 71, and that's a 9 pip advantage. Now remember, our original stop loss was only 22 pips from the entry price to that area there, 22 pips. And now we've reduced it by 9 pips, so we can get a 13 pip stop loss. So instead of a 22 pip stop loss, we've now got a 13 pip stop loss, and that enables us to get into the trade with a very low risk-reward ratio. In other words, a very favorable risk-reward ratio. I'm going to show you 2 more examples of this before I go on to the next method to reduce your stop loss. Right, here's another really good example, and I'm going to use the dollar yen extensively to do this, just simply because it's easier for me to stay on the same chart. Now, what we have here is a situation where we have a trend line. Once again, we're through the top Bollinger Band. We have an overbought stochastic, and this trend line is just about 3 hours long. You can't see underneath, but this trend line is 3 hours long, and we're generally in an uptrend here. You can see that this trend line here has acted as support, and we've drawn the trend line underneath the price action. Remember, if we're going up, the trend line is underneath. If we're going down, like we are here, for example, the trend line is drawn on top. All right, so we have all the conditions for an entry right now, and the first thing I'm going to do, as I always do, is if I get an entry signal, I check to see where the stop loss needs to be. Now, if we have a look at the high here, the high is 98.84, so the stop loss would have to be at, let's say, 98.90, and the original entry here is at 98. Let's just have a look at the close of this, 98.60. All right, so we know that we need a stop loss at 98.90, so our stop loss would have to be here at 98.90, and our entry is at 98.60, and that gives us a 30 pip stop, which is within the limits of what we accept in E75, but obviously we would like that to be smaller. So the first thing we do then is, once we get the trade set up like we do right now, is we wait for a retracement back to the trend line. And once again, ideally we want the price to touch this trend line and then move lower. Now look to see what's happened here. We've got the move slightly lower, and that takes about, I suppose, half an hour, and then we get this big bullish candle, this white one right here, and we go all the way back up to the trend line. Now remember, that trend line was resistance, support. This trend line support all the way along here, and now this trend line becomes resistance. And you can see the price has moved up to touch that trend line, and we've got this big bullish candle followed by what's called a dark cloud cover. I'm just going to put DCC, dark cloud cover candle. That's this black one coming down. Now, don't worry too much about that, because I'm going to talk about candlestick patterns and that sort of thing later on in the course, and how you can use those to effectively improve your trading. Now, what would have concerned me is this initial bullish candle. You can see we went right up to the trend line. Then we got this dark cloud cover, which is a reversal candle. And you can also see that we didn't manage to close above the trend line here. We just managed to spike up through the trend line and then move back down towards that. Now, what I would have done in this case is waited, after this big bullish candle, is waited for some confirmation that in fact we were going to reverse and move back downwards. And that's what we got after this dark cloud cover candle. Now, once again, I'm not going to go into the mechanics of using candles to help you with your entries, but let's just assume that as we go along later in the course and you understand this, let's just assume you knew that if we had this big bullish candle, which was obviously concerning, it looked like it was going to rush higher, and let's say you knew that if we had a reversal pattern here, that that would be the place to enter. Now let's have a look at this in perspective. So we had 98.90 and 98.60 as our entry right now, and if we entered at the end of this dark cloud cover, having tested the trend line from underneath, having confirmed that it's now resistance, you can see in fact that the entry price would have been around about here. And if I have a look at the price right there, we've got 98.66. So we've saved ourselves 6 pips on the trade simply by waiting for the retracement to the trend line, and in this case, waiting for a confirmation that in fact the trend line was going to act as resistance. Now, it may well be, if you're a more advanced trader, that you would have taken the trade right there as the price hit the trend line. Now, have a look at the high of that candle, 98.75 instead of 98.60. So what that means is we've actually effectively cut our stop loss from 30 pips, which was the original stop loss if we'd got in over here, and we've cut that down to just 15 pips. And so we've reduced the risk by half. Now that's an absolutely fantastic approach to trading when you don't really want a 30 pip stop loss if you can help it. When I say 30 pips is allowable, that's really the maximum that I'd like to have on the trades. If I can get down to, let's say, 25 pips or 22 pips or 20 pips all the way down to 15, let's say, that's probably about the smallest you'll be able to get. I've seen, in fact, a couple of trades we've taken in the webinars where we've had a 12 pip stop loss. But by doing this, we've actually halved the risk on the trade. And that means in order to achieve a 2-to-1 risk reward ratio, then we only need to aim for double the stop loss, which is 30 pips on the trade. And so having got in at, let's say, 98.70, we want to get 30 pips on the trade, and so we wait for the price to move down to 98.40. That's right here. As you can see, the price did that. So we've gone from 98.70 to 98.40, and that's given us our plus 30 pips off the trade. And that's given us our 2-to-1 risk reward ratio. We've had a very small risk of 15 pips. We've put 30 in the bag, and the whole thing's hunky-dory. So I'm going to show you one more example of this, and then we're going to wrap up the retracement to the trend line approach. Alright, so in this case, I've chosen a bullish scenario on the dollar yen. And what we've got here is the price moving downwards, and we've got the trend line on top of the price in this case. So the trend line is running down on top of the price. So when we've got a downward movement, we always draw the trend line on top. We then get an entry opportunity, and you can't see down there, but we've got an oversold stochastic. We've got this very beautiful situation where we've got a confluence of Bollinger Bands. Okay, you know what that means, confluence. Confluence of Bollinger Bands, in other words, the 100 period Bollinger Band, that's this grey one, and the 200 period Bollinger Band, that's the green one, are very close together. In fact, they cross right here. And at the moment of entry, you can see the Bollinger Bands are very close together. We've got a trend line that's 3 hours long or longer, and we've got everything set up for an entry signal. So as normal, let's go and have a look at the stop loss required. And what I do is I just put the cursor on there and I have a look at the low of this candle, and I've got 98.58. So my stop loss would have to be at 98.55, let's say. Now let's have a look at the entry, and the first bullish candle that covers, or where we get the entry, is at 98.85. So straight away, in fact, we'd have a little bit more than that because of the spread. So we'd probably only be able to get in at 98.87, and our stop loss would be at 55, and that gives us a 32 pip stop loss, which is really outside. In the previous videos I've said, okay, maybe 35 pips, but we really don't want anything more than 30 pips if we can help it. And if we can get less than 30 pips, even better. So we've got a 32 pip required stop loss, and we've got an entry right over here. Now look what happens. Remember that this trend line, as normal, was resistance, and now the trend line becomes support. And I'm just going to clear the screen. So we've got an entry price over there at 98.87, and the stop loss we said was at 55, so that's a 32 pip stop loss. But look what happens. The price then moves back down to the trend line over here, which was resistance, and now becomes support. And in fact, if we waited for the retracement, we're able to actually enter the trade somewhere around, I'm just going to draw the line because, well, let's get it down here, just a little bit lower, at around about 98, let's say 77. So instead of 87, we've got a stop loss at 98.77, and that reduces our stop loss from 32 pips. Okay, let's rewrite that. From 32 pips, and we've now managed to get a stop loss of only 22 pips. And if that's the case, then we're able to aim for about double that, which would be, let's say, 40 pips. And so we're looking for about 40 pips on the trade. So we get a 98.75 plus 40 gives us 98.15. Is that correct? 75 plus 40. So we're aiming for about 99.15. That's over here. And you can see we get very close to that at about 99.12. And so we've managed to get 40 pips out of the trade, thereabouts, maybe a little bit less, by only risking 22 pips on the trade. So this is a technique which is very simple to apply. Once you get the break, you then simply wait for a retracement back down to the trend line. If you're going up, which acts as support, it was resistance, it becomes support. And as you've seen in the other examples, if we've got a trend line going up and we get a price, let's try and draw this on a clean section of the screen. So if we've got a move going up like that, and we get the price breaking downwards through the trend line, just extend that a little bit, we then wait for a retracement back to the trend line, which was support, now becomes resistance, and then we can enter the price hoping for a move down with a smaller stop loss. And so the idea of this is to reduce the stop loss either from 30 pips to, let's say, 20 or so, or if the stop loss needs to be, let's say, 37 pips, simply because of the volatility of the price action, and we want to get it within the 30 pip limit, let's say we can reduce that down to 27 pips by simply using this technique. And you've seen in all of these examples, we've managed to reduce the stop loss by somewhere around 60%, and in some cases we've cut it in half. I'm going to explain why the 62% comes into it in a little while, in the next section of this discussion. So we've now talked about the first method of reducing your risk, your stop loss, and the effect of losing trades, and that's a retracement. I'm not going to write this thing all out, but it's a retracement to the trend line. That's okay, that's not T4. A retracement to the trend line, that's method number one. That's one of the most simple methods to apply. Anyone can do it. It's just a simple matter of waiting for the break, retracement back down to the trend line, and in this case we moved along a little bit sideways, and then the move up. Okay, so that's retracement to the trend line. The next one I'm going to talk about, number two, is retracement to a Fibonacci level. And very often these will coincide. So the retracement to the trend line and the retracement to the Fibonacci level will coincide and give the same entry point where you can enter the trade with a low risk. So let's talk about retracement to the Fibonacci level, and I'm going to use the same example that we have on the screen right now to demonstrate this to you, and show you exactly how we can go about this. All right, so now we're going to talk about retracement